I'm about to share with you how easy it is to make $7,000 per month trading just one setup across one asset. So let's jump over to the chart here. We have the US 30, which is the asset that I chose to take these two trades. And I'm just gonna zoom out on the 4-hour chart just to give you a higher time frame perspective. But we're gonna use two time frames here, just the 4-hour for bias and 15-minute for entry. That's it. I'm gonna keep this super simple. Back to basics, as less is often more. Now we can see here this sell-off here after the 2nd of April. That was the introduction of the Trump's tariffs, which sold the market. And then since then, we've seen that steady recovery. Now we'd expect price, as it's creating higher highs and higher lows, to continue to the upside. So when we see this take on liquidity, what are we expecting? We're expecting buys and not sells. So there's the first inclination and the first confluence for trade direction. Also, what happened a few days earlier before, and I have this on bar replay, so I don't have this on view yet, is this market opening gap on Monday, the 12th of May. So on US indices, when we get a market opening gap, which is basically large amounts of volume and orders that the broker feed cannot fulfill, price tends to come back and fill. And I'm just going to show you the last 3 or 4 market opening gaps. We have one here and it's filled. We have one here and it's filled. We have one here and it's filled. Now, typically within a few days or the same trading week, price will come back to fill that gap. So this one over here, which was the 23rd of March, 2025, was filled on the Friday. The others took between 1 and 2 days to fill. And then this one actually took a bit longer. It took 2 weeks, but it still came back to fill. And I see these market opening gaps the same or equal as a 4-hour high or low. So it's a form of liquidity. So I'd recommend you adding these in, and you can just mark it out as something else. Now, what's more important as well is after price filled this gap, you can see 50% of it was wick, and we had that 4-hour retrace. So we had a 4-hour bullish candle close right afterwards. So it's a recovery straight in and straight out of this. So if we look at this from a 4-hour perspective, we can put our 4-hour range high and 4-hour range low, which is our final bearish range. Those that have seen my videos before will know I use these. And then what we can do is plot a new 4-hour range, which is now bullish to the upside as it's created a higher high. Now, what are we expecting? Macro, which is the higher time frame, the bigger picture, zooming out, is we're expecting higher prices. The stock market is recovering. That's what it is. It's the US economy. So we expect after a big sell-off, a lot of the stock markets dropped anywhere between 5 and 20%. We're seeing a steady recovery. We have already cleared above the original price before the tariffs. And why would we fight the trend as it's continuing to the upside? We have the overall higher time frame targets way up here, so we have loads of room to be buying, right? Of course, we can look for sells as well, and there is one buy and there's one sell in here that I'm going to show you exactly how and why I took it. So if we now go down to the 15-minute, because our 4-hour is essentially done. Unless we break a new high, our 4-hour is done. Now, the first trade was on this Tuesday, the 27th. I do want to go back and just show you actually what we have here is a level of liquidity which price came to take. So if we jump back to the 15-minute, we can see that now. And price on the 15-minute is forming lower lows and lower highs. But what's important? The importance here is the higher time frame. So don't get too zoomed in to the 15-minute or the lower time frames, because that's often where you'll miss out on opportunity. You'll let it pass. So what happens here? We take this form of liquidity and prices broke to the upside. The entry is not there yet. This first session that took liquidity was during Asia anyway, and then London continued to the upside. So first of all, let's go back to the 4-hour because we need to adjust our 4-hour range. So let's rein this one in, our first bullish range, and we'll take a new one. Let's borrow this. And we have a new 4-hour range. So we have a 4-hour external range low liquidity resting here. And another thing to factor in is how small is this range? The previous range was very large, so it's very unlikely that price is going to go from here and take all of this liquidity out to the external range low. And if it does so, we'd be bearish, right? So what's the difference now? Price is here, only has to move to here, so it's not a long distance. The external range low is a better area of buying than internal range. And also, if it does take this low, it doesn't mean it's bearish because it has to break these lows way down here. So that's the 4-hour perspective I was waiting for. And although we'd already taken a level of liquidity during Asia, the other confluence is session-based liquidity. Now, if you go back a few videos, I think 2 videos ago, I did a video on internal range versus external range liquidity. And I talked about session-based liquidity. So if we look here, what did London do? Price during London just pushed higher. It didn't take Asia lows. It didn't take any form of 15-minute liquidity. Yes, Asia did, but London did nothing. So where's the inducement? This is inducing buyers in, early buyers, as their stops will be anywhere on the lower time frame in this period. So what I expected was for price to come back. If I draw this on, and take either London lows or maybe even take Asia lows as well as the 4-hour external range low before looking at buying opportunities. The other thing that we can mark out is the Asia itself as an area of confluence. Price likes to come back and mitigate, retest the Asia session. As you can see, here's an example of the previous day that did exactly that, especially that first opening hour of Asia. But that's something for another video. Let me know if you want me to go into great detail about Asia confluences. So let's play this forwards. I expected lower prices. We have London lows right here. You can see this candle smashes straight through London, straight through Asia, and into the 4-hour external range lows. So we can remove that. We're on the 15-minute time frame. We're keeping it super clean. We just want a 15-minute bullish close as a retrace candle for entry, which I believe we get next. And there we go. So all we need to do, you can enter on the whole candle if you wish, but if you are really confident in your trade idea, then just market execute on the close, especially at 4-hour levels. So I'm just going to move this to remind us that that is a 4-hour low in a higher time frame. So 4-hour, daily, even weekly bullish market. And play this forward. Take profit at the 4-hour high. Yes, it can push higher, but this is where I closed out profits for almost a 3.5 to 1 for 1% risk trade. And there we go. That first position made almost $3,000 on a 100K account with Funder Pro. So what have we done here? We have broken above the 4-hour range. So let's go back to the 4-hour. Did we have a new low and a new high? Yes, we did. So I'm going to again rein this in, borrow this and create a new 4-hour range. We have the high at current price and the low at the sweep. If we come back to the 15-minute and we need to play price forwards, like I say, you could hold this and you could target another area of interest if you wanted to. That's absolutely fine. You could target these previous highs, but there's nothing wrong with a fixed 3 to 1 or targeting a close by 4-hour high or low level. So the next trade was on the 30th. So I'm going to play this forwards. This would have been extended as a 4-hour range. Let's just take a quick look and make sure. Yes. Now, why is this a short? If I've just talked for the last 10-15 minutes and showed you exactly how and why and where I got into a long position and why my bias was longs, why am I on the next trade, contradicting myself, you might think at this stage, taking a short? Well, this is where confidence and experience comes into play and knowing what's the difference between a pro-trend move and a counter-trend move. I know I'm countering, which means if I'm entering a short anywhere in this region, I'm not expecting price to make new lows and holding this position to the ground, right? I am looking for either a fixed minimum 2 to 1, ideally a fixed 3 to 1, which I got in this one, or potentially a session-based low. Now, in this case, the only session-based low that we have is the 4-hour low. And a lot of the time, we don't want to expect 4-hour lows in a 4-hour bullish market for counter-trend price to actually reach, because it's going to take a lot of liquidity to do that. Plus, we've just taken 4-hour liquidity. Price is not going to likely come all the way back again and take 4-hour liquidity the very next day. Usually 4-hour liquidity gets taken once or twice a week max, right? The other thing is, why am I looking at shorts? I'm expecting the pullback. We've had a very considerable push higher. There's no inducement inside this area, so price is going to have to engineer liquidity on the lower time frame before then shifting back to the upside, and I'll start looking for buys again, which is exactly what I did. So let's play this forwards. And first of all, look at Asia session. So again, if I have enough requests, I can cover a Asia opening range video on how I look at that as a confluence. I'm expecting price to basically either come back and mitigate Asia or take the highs and react. Now, the second thing is I'm just going to look at the nature of price, which is falling in a very corrective and descending manner, which makes sense because we're bullish. So I'd expect price to push higher. And of course, this is very early. London has just kicked in now. I'm not looking just to take buys in here. Certainly won't be looking at sells in here. Like I said, there's no liquidity or inducement to the left, and price is falling in a very corrective manner. I'd expect it to push out to the upside. We're now between London and New York, inside that London lull. No opportunities yet. Now it's mitigated the opening hour of Asia. Don't worry if you don't understand what I mean. I haven't covered that yet. We can see a reaction, but this is not trading time. This is 12 p.m. midday UK time. We have another 2 hours until New York opens. So let's push this a bit further. And there we go. There's your manipulation. And that retrace candle is exactly what I was looking for. If we didn't have that 15-minute reaction straight away, immediately, 1, at the 4-hour highs, 2, I'm expecting a pullback, and 3, this is straight after New York open. If this bullish candle was followed by a second bullish candle, and price continued higher, like so, what I would be doing instead, and my students know, I'd be dropping down to a 5-minute time frame or maybe even a 1-minute time frame and simply looking for continuations to the upside. But we had an immediate reaction, which ends up being a 4-hour wick as well. And quite simply, the close of that retrace candle stops above the high, 3-to-1. This was my trade. Just like I said, I'm expecting a pullback, which is counter to the overall trend, but I'm expecting that reaction to pull through, take some liquidity, and then potentially hover around overnight, and then shift back to the upside, which I believe is pretty much what we got. So we'll play that forwards like so. And I actually manually exited the position around here for 3-to-1. It did actually reach my fixed take profit anyway, but you know, when you are, this is something to think about with trade management. If you have a take profit at 3.2% or 3.2R and price is running at 3R, would you sacrifice that 3%, that $3,000, or potentially $6,000 if it's a 200K account, to really want to feed your ego to get that 0.2? Or is it best to just take your profits, right? I'm not saying close your trades early. If you're targeting a 5-to-1 and closing it at a 1-to-1, then that's a psychological issue. But if you're looking at 0.2%, close that trade out. And that's exactly what I did. Especially, I'm being more aggressive with my trade management because this is counter to the overall trend. I moved my stops to break even as soon as price went to 1-to-1. Usually on pro trend moves, I don't take risk off until a 2-to-1. And I'm closing out at a 3-to-1, not expecting price to come down to these 4-hour lows like I mentioned earlier. And if I just played forwards, I don't believe it does push much lower. There you go, the reaction almost instantly overnight. So I hope you took value in the video. If you're still here to the very end and you're interested in learning all of the confluences that I add to this to make my strategy super simple and repeatable, that allows me to extract on average 5 figures every single month, and in April 2025 made me over $120,000, then there's a link below. Fill out the application to book a call, and I'll see you on the next video, guys. Cheers.